here. Okay, there we go. The presentation today is tax savings with S-Corps, C-Corps, LLCs, and sole proprietorships explained. The format that I'm going to go through today is to, I'm sorry, somebody just joined us and I'm getting echo from them. So if you just joined us, if you could mute yourself. I'm still getting echo. I could mute everybody, but I don't really want to. Still getting echo? Well, let me try to mute some people. Still getting echo? And still getting echo? I might have to mute everybody. Okay. Okay. The echo's gone. That's great. Okay. So anyway, the format that I'm going to go through today is just using the same example under the various different business entities. So we're going to make a number of assumptions to simplify this. And we'll start out with the C corporation. Now, the assumptions that we're going to make include that the net business income is going to be $100,000. So it doesn't matter what your revenue is. Whatever your revenue is minus your expenses, it could be $1 million in revenue minus $900,000 in business expenses. Whatever it is, you've got $100,000 of profit. Now, if you were a C corporation, C corporations are a separate entity that pay their own tax. So a C corporation starts out in a 15% bracket for the first $50,000, but climbs pretty rapidly after that, up to a 35% bracket. In the marginal brackets climb higher than 35%, but the total is never taxed more than 35%. So that in this example, a C corporation with $100,000 of profit is going to pay corporate income tax of $22,250. Now that's going to leave you with after-tax profit of $77,250. Now that is not too bad as far as the other examples that we are going to go through, but we're not done paying tax here, because right now this money is sitting in the C corporation's bank account, and you of course want to use it to pay your grocery bills, pay the light bill, that sort of thing. So we're also going to make another assumption that the owner of this entity is in a 35% tax bracket. So we'll go to the next slide, and in order to get that money to the owner, it's got to be done in one way or the other. It could be done as salary, or it could be done as a dividend. I'm going to see if I can mute everybody here. So hold on just a moment as I go through this. So I'm just kind of getting too much noise. Just a moment. I haven't done a ton of these. I'm sure there's a way of muting everybody at once, but I don't seem to find that. So if you have questions and I've muted you, just type your question in the chat area, and then I can, if you put your name there, I can unmute you as well. So that seemed to have, I haven't muted quite everybody, but that seems to have solved the noise problem. So anyway, we got to get this money to the owner so that he can use it to pay his bills. So we could do that as a dividend, but when you do that, you're receiving dividend, the owner is receiving dividend income from this corporation, so they get the privilege of paying tax again on this same money. So this is the double taxation that you've likely heard about with C corporations. So luckily it's a reduced dividend rate. It's only 15% at this point, but that could go up in the future. So that the owner has to pay tax on this dividend of $11,588. So after the C corporation pays tax and then pays what's left over to the owner and he pays tax, then he or she is only left with $65,662 to buy groceries. So let's look at this with some different type of entity and see if we can get a different result. Well, actually, let's. I mentioned before that in order to get that money from the C corporation to the owner, it could be done with a dividend or it could be done with salary. So let's go through an example where the owner pays a salary to himself. So again, we're assuming $100,000 of profit before the owner pays a wage. Now, there's employment taxes that the C corporation is going to have to pay on this salary. So it can't pay a wage of $100,000. It's got to pay a wage of just under $93,000 so that it has money left over to pay the employment taxes. So the employment taxes in this example would be $7,106. We go to the next slide. That wage is paid to the owner. Again, remember the owner's in a 35% tax bracket, so the owner has to pay taxes on that salary of over $32,000. In addition, the owner has Social Security and Medicare withholding also, and that's just over $7,000. So that's going to leave the owner $53,275 to buy groceries or pay for the light bill or whatever he or she wants to do. So not a lot of money left over, especially if you're in a 35% tax bracket. So let's look at a different entity then. The most common would be a sole proprietorship. Again, we're assuming that this owner is going to start out with $100,000. We assume that they're in a 35% tax bracket, so they're going to pay $32,527 in income tax. The reason it's not $35,000 is because half of the self-employment tax is deductible. But they're going to have to pay self-employment tax of $14,130. Now, self-employment tax is 15.3%. That's a pretty high percentage, and it's that percentage up to the wage base. The wage base is $106,800. After that, it drops down to 2.9%. But anyway, on top of his $32,000 of income tax, that $14,000 for self-employment tax is pretty high, and it's going to leave this owner with only $53,000 to spend on personal expenses. Now, before I get into S corporations, I don't really have a slide that talks about LLCs. And the reason I don't is because a single member LLC is ignored for federal tax purposes. There is no LLC tax return that with the IRS. So the if you're an LLC, you can elect to be taxed as something different. But if you don't make any election, a single member LLC is just taxed the same as a sole proprietor. So this slide that I have for the sole proprietor applies for the LLC as well. So if I just had an email today from somebody that said they created an LLC for their business a year ago and expected to have some significant improvements in the tax that they paid. And of course it didn't happen because all they've done is add liability protection. Now, the importance of that's not to be understated. It's a very important thing, but it's not going to do anything, it's not going to change anything for taxes compared to being a sole proprietor. So let's look at an S corporation then. Now, S corporations, the S corporation profits are not subject to self-employment tax. And as I've pointed out, that self-employment tax is pretty significant. And that's the reason we look at S corporations pretty frequently to save on self-employment tax. An S corporation, unlike a C corporation, is called a flow-through. All of the income from the S corporation flows through to the owners, and the owners pay tax on that income. So that's why you see in this example there's zero corporate income tax. So we have a profit of $100,000, no corporate income tax, so there's $100,000 that could be paid to the owner. Now, if that could just be a distribution to the owner, a profit distribution. Remember, as we assumed the owner's in a 35% tax bracket, there's no self-employment tax here, so the income tax is the full $35,000. That's going to leave this S corporation owner $65,000 to buy groceries. Now, that sounds like a lot of tax, not that much left over, but remember, we did assume that this person was in a 35% tax bracket. In order to be in that tax bracket, they've got to have income from some other sources because that's our top tax bracket at this time. So yeah, not a great example, but certainly better than the sole proprietor or the single member LLC that ended up with $53,000. Now the problem with this, though, this would work fine if this person had a business that was just an investment. I see a question from Michael here. Please explain the LLC comment again. Is it identical to the sole proprietor case? And yes, it is. A single member LLC is ignored for federal tax purposes. When you have a sole proprietorship, all of your business income and expenses is included on Schedule C of your regular 1040 income tax return. And if you create an LLC, it's the same thing. It's ignored for federal tax purposes, so you're just putting all of that income and expenses on Schedule C of your 1040. So nothing has changed. Now, an LLC could elect to be taxed as something different. It could elect to be taxed as an S-Corp. So that would change, of course. And again, Michael is asking, what about multiple member LLCs, say 3 partners in U.S. and 2 foreign partners? Well, a multiple member LLC is, by default, is considered a partnership. So that partnership would be doing, well, you complete a partnership return, which is 1065. Now, if you are an owner of a multiple member LLC and you're working in that business, that is still self-employment income. So you're still paying self-employment tax. Now that doesn't apply to the foreign owners. In Michael's example, he's saying 2 of the partners are foreign owners. So they wouldn't have and the other thing is their investment is limited. Sounds like they wouldn't be working in the business. So, but for the domestic partner, there's still self-employment tax, and it's still a flow-through. So their example is still going to be the same as the sole proprietorship example. If their share of the profits is $100,000, they're still going to have self-employment tax on that full $100,000, and they're still going to be paying income tax on that full amount. All right, let me back up a little bit here. Michael was asking why I'm assuming a 35% tax bracket. Well, I have to assume a fixed tax bracket in order to present these examples in a fairly simple method. If we're, the way tax brackets work, the first income you earn isn't taxed at, it's taxed at 0 because you've got to get to your, exceed your itemized deductions and your personal exemptions before you pay any income tax. And then you have an amount that's taxed at 10%, some that's taxed at 15%, going on up. But that would just make these examples too convoluted and too difficult to understand. So that's why I'm assuming a 35% tax bracket. The other thing is that this strategy here with the S corporations that I'm kind of just starting to get into really doesn't have much to do with income tax. It really has more to do with self-employment tax. Connie is asking, for a sole proprietor, is a tax ID number needed, or is the owner's Social Security number the only thing needed for filing taxes? Also, what tax bracket was for the sole proprietor? If you do not have any employees and you are a sole proprietor, you can use your Social Security number. You don't need a separate tax ID number. Once you hire employees, then you're going to need to apply for an employer identification number. And then you're asking what tax bracket was for the sole proprietor. Well, we're assuming for income tax a 35% tax bracket for everybody. And then Shakun is saying, can an LLC owner select filing tax as an S Corp? And yes, you can do that. So the example that I'm presenting here with the S Corporation applies to somebody who's created an S Corporation or who has created an LLC that has made an election to be taxed as an S Corp. And then Michael's asking, okay, the foreign partners would be working in the business. Well, if they're, I see, okay. Going on here, and Marlene is asking, can you have a single person S Corp? And yes, you certainly can. So I presented this example of the S Corp where they don't pay any salary. They take everything as a profit distribution, and they end up with $65,000 for personal expenses. And that's fine if you're not working in the business. But if you're working in the business, the IRS requires the owner to pay himself a reasonable salary. So that's why the next slide is the police officer sending you to jail. Now, it's a bit of an overstatement. Actually, you just end up with, well, you'd likely get audited and likely have to pay penalties. The IRS, if they audited you and saw you had no salary, but you took everything as a profit distribution, they would say, well, we're going to call that, we're going to call all of that distribution salary. So now you owe employment taxes on that salary. Well, the employment taxes, that's not that bad in the sense that you would have had to pay those anyway in self-employment tax if you were an LLC or a sole proprietor. but now you're also going to have to pay penalties, or likely would have to pay penalties on top of that. So what you need to do, the other thing is that if you paid everything out as salary, then there'd be no advantage in creating an S corporation, because your employment taxes would be just as high as your self-employment taxes. So we want to pay a salary, but not necessarily 100%. You're required to pay a reasonable salary. That doesn't necessarily mean it's 100% of the profit. So in the next example, I'm presenting an S corporation with an owner that's paying himself a salary of $20,000. Now, that's fairly aggressive to call $20,000 a reasonable wage. It's fairly low. But there could be examples that would justify this. If a fair amount of the profit was earned from capital, or perhaps from the leverage offered by the employees. Perhaps the owner isn't working that much in this business. It's just kind of a side thing that they work part-time on. So anyway, the owner is paying himself a wage of $20,000. The S corporation has to pay employment taxes of $1,530. Now, the owner also has Social Security withholding of $1,530, as you see on the bottom there. And since they're in a 35% tax bracket, they're going to pay almost $35,000 in income tax. So that's going to leave them with a little more than $62,000 to buy groceries. So not quite as good of an example as the person that paid no salary, but with the extra self-employment tax, or employment tax rather, that you've paid here, you're buying yourself a lot of security, much less likely to be audited. Still fairly aggressive probably, depending on the example, but much less likely to be audited, and you're still saving significantly over the sole proprietor. So Matt's asking, how do you determine the correct wage to pay yourself? I've heard many thoughts on this subject and was interested in your take. Well, that's a very difficult question, and it's one that I never answer with a number. My philosophy is to educate my clients and have them make an educated decision as to what their salary should be. It's their industry, they know more about it, their industry, than I do, so I help them make that determination. So you need to look at where the profit's coming from. Is the profit coming from a significant capital investment? Is it coming from the leverage that's offered by employees? Is it just coming from your hours? I was at a presentation a couple years back with somebody that headed up the S Corporation division for the IRS, was talking about this subject. And he pointed out an example of an attorney making $500,000 a year, but the attorney didn't have a secretary. So he was saying that theoretically that entire $500,000 should be salary. The idea is it's not coming from any capital investment, it's not coming from employees, it's just his hours, so therefore should be salary. You could get people disagreeing with that. You'd also have to take a look at where your risks, what kind of risk do you have. Really, they just want to see a reasonable salary. Some people might argue that a reasonable salary in that example would be, more like $150,000. Another question you'd ask is, what would it cost to hire someone to do what I do? And decide how aggressive or conservative you want to be with that number. The IRS doesn't provide us a formula for determining what the reasonable salary should be, but one thing I'd like to point out is that it's not just a number. It's really all the facts and circumstances that go into this. So it would be helpful to do some, if you're going to do this, if you're going to create an S corporation and pay yourself a salary that's less than 100% of the profit, you can do some other things to protect yourself. You should do some contemporaneous research on what that salary should be. Go someplace like salaries.com, or I'm sure there's a number of different sites that would provide information about that. Take a look at some demographic information. Maybe this part of the country the salaries are whatever, 10% less than they might be somewhere else. Do this research, document it, include it in your minutes, and include some discussion in your minutes about what the salary policy is for the company. That way, if you're audited in the future, you could show that this wasn't just willy-nilly a number picked out of the hat, and then I'll pay the rest as a profit distribution and avoid self-employment tax. But you've come to a valid decision on what your salary should be, and who is the IRS to rethink that decision. Now, you have to be reasonable, but the business judgment rule says that you get to make these business decisions on what's best for your business. That argument won't go very far if you decide your salary is 0, or if you decide your salary is $5,000 when you've got a couple $100,000 in profits. But I think you understand what I mean. When you have foreign partners, Marlene is asking, when you have foreign partners for tax purposes, is it better to form one S Corp or have separate businesses? The S Corporation is not really an option for a foreign partner. You have to be a U.S. resident or citizen to have an interest in an S Corp. So if that's the case, if you've got foreign partners, then you're going to have to choose something like a C corporation or an LLC. And then Michael is saying, looks like a C Corp is the way to go, $65,662. What are the limitations? Well, C corporation is much more inviting than it used to be, because they've lowered the dividend tax. So it's much more equivalent. But the other thing is that the whole reasonable salary issue could also come up in the C corporation context. So in that slide that I showed you, where the C corp owner was getting $65,000, the IRS could make the argument that they should be paying a salary of some amount. So that's still an issue. The other thing is that because we've decided that, because we picked the 35% tax bracket to simplify these examples, it does skew things a little bit, because the example I showed with the C corporation, one of the reasons that the tax is less in that example compared to, say, the S corp, is that that person is in a 35% tax bracket, and a lot of that income is being taxed inside the corporation. So the C corporation is saving some money on income tax. So I really wouldn't say, you can't really make a blanket overall statement that the C corporation is best or that the S corporation is best. You really have to look at your particular situation. And if you're not in a 35% tax bracket, well, let's run the numbers for your tax bracket and find out what's best for you. And we're going to have to make some, decisions on, what are you going to pay yourself as a reasonable salary? And if that salary is going to be 100%, then, that's the S corp isn't going to be your answer. Okay, so Michael's asking, question about foreign partners between the LLCs and the C Corp. I think that we'd have to take a look at their particular situation to decide that. And so Jill is asking, how is the remaining profit distribution taxed? Well, the profits are, it's not really in the S Corp, it's not really the distribution that's taxed, because remember, an S Corp is a flow-through. So the owner is taxed on all of the profit of the S Corporation, and it's taxed just at your marginal tax rate, and it's just ordinary income, so they're going to pay tax on that profit. Okay, thanks, Matt. Salaries.com. There's the link. Okay, let's take a look here. I've included a couple slides, and I'll send everybody an email in the next couple days that will include a PDF document with all of the slides. So, and it will also include these graphs showing the tax rates, both for corporations and for the next slide is married filing joint. But as you can see, this is what I was talking about the corporate income tax. The first $50,000 here, taxed at only 15%. Climbs up pretty high after that. The total tax is never going to exceed 35% of the total profit. But what they're doing in some of these brackets here, like the 39% bracket, is they're taking away some of that prior benefit. Okay, so I'd like to answer some more questions. Actually, let me talk about a couple other things that could affect the decision of whether this is going to be, whether you should have an S Corp or LLC or something else. One thing is that if you have a home office, the home office deduction, it's not deductible against S Corp income. Now, if you have an S Corporation and you're paying yourself a wage, you can deduct it as an unreimbursed employee expense. But that's not as attractive of a deduction. Unreimbursed employee expenses are, first of all, they're itemized deductions, so you have to itemize. And they're only deductible to the extent they exceed 2% of your adjusted gross income. So if your adjusted gross income is $100,000, you're going to lose the first $2,000 of that deduction. So a $5,000 home office deduction turns out to be a $3,000 home office deduction. So that's another thing we'd have to take a look at for your particular example. So Kevin is asking, can you address Shakun's question about paying FICA once over the threshold? Okay, so in employment taxes, there's two components. One component is the Medicare, and the other component is the Social Security tax. The Social Security tax, I mean, that's a retirement plan. So once you reach the wage base, and the wage base is now $106,800. Once you reach that wage base, they figure, well, you've already paid into your retirement plan. You've already paid enough to get whatever benefit you're going to get out of Social Security, if you ever get anything out of Social Security. So you don't have to pay on any income above that. So even if you make $1 million, a person that has earned income of $1 million is going to pay the same Social Security tax as a person that makes $110,000. And that's going to be 15.3% of that wage base, the $106,800. Medicare is not like that. Medicare is 2.9%, And it doesn't matter if your earned income is $500 or $1 million, you're going to pay 2.9%. So when you put both of those together, the Social Security is, let's see, Social Security is 12.4. You put that together with the Medicare, adds up to 15.3%. Once you reach the wage base, the Social Security portion drops off, and you only have the Medicare portion, which is 2.9%. So I hope that answers your question, Kevin. Actually, maybe I can unmute. Kevin, does that answer your question? Oh, there you are. I see you've answered in the chat. Okay. So Ty is asking, I was told that you can write it into the bylines of the corp that every employee has to have a home office, and now it can be a biz expense for the corp, right? If this is a C corporation, that works. So for it to be an expense for the C corporation is going to have to reimburse the employees for that, and the employees, because it can't deduct it if it doesn't pay it. And for the employees to deduct it, I mean, well, now the employees have rental income, basically. Now, it could work out that that rental income nets out to zero once you subtract all of your expenses, your home office expenses. So you've got depreciation, you know, a percentage of your utilities, percentage of your mortgage, property tax, homeowners insurance, security, gardening, maintenance, on and on and on, whatever it takes to run your home. It's possible that could net to zero, but that payment from the C corporation to its employees is rental income. So that could work if you've got enough expenses to offset that rental income. That could work fine. Okay. Any more questions? Let's see here. Okay, so Michael is asking, home office, is it legit to pay rent to my family and have it taxed as ordinary income, no Social Security or Medicare? Can I establish rent at what the equivalent cost would be if I rented an executive office in the nearby city? Well, that I'm not quite sure what you're asking, Michael, in the sense that you can deduct a home office yourself. It doesn't have to be paid to a family. If it's paid to a family member, it's treated similar to it being paid to you. So that works, but it's not going to get you around the S-corp problem. It's still going to be deductible only as an unreimbursed employee expense. So Matt's asking, for the home office deduction in an S-corp subject to the 2% floor, is that only if you don't have another office location? Well, you won't get the, in order for a home office to be allowed at all, it needs to pass a certain test. It needs to be either your principal place of business, a place where you meet clients on a regular basis, or it needs to be a separate structure. And also, in addition to that, you need to have an area of your home that's used exclusively for business purpose. You need that to get the home office deduction at all. under any scenario. And so once you've met that test, then with an S-Corp, it's only going to be deductible as an unreimbursed employee expense like I mentioned. With an LLC or sole proprietorship, it's going to be a straight business deduction. With a C Corp, well, you know, the C Corp could pay rent, and it's the same example I mentioned before. So Michael is asking, the expenses, if I did it on mortgage, utilities, etc., would be much less than the rent I'd charge, $850. I'm not quite sure. Let me see if I can unmute Michael here. Michael, yeah, I can hear you now, Michael. Can you expand upon that? I'm not quite sure what you're asking.
Well, sure. Yeah, a friend of mine and I were talking about how to take the best advantage of having an in-home office, and what he did is looked in the community and found out what it would cost to have an executive office of the same kind of size that he has as a room in his home, and it's $850 or $1,000 a month for rent in order to have the space in a commercial office building.
Okay.
And so he pays his family $850 a month. They have to, they have to look at it as ordinary income, and it gets taxed as additional income at their tax rate. But that is, he does not have to pay then tax, Social Security or Medicare tax on. He's able to protect that much more of his income by having this, expense, which $850 worth of expenses is going to be more than what he's going to be able to take in his mortgage, which maybe he'll get $100 for that, and he's got, $50 of utilities, and there's not really much more to claim.
And what type of entity does he have?
It's an LLC.
Okay, all right. Yeah, that works. So you're saying that he's getting more advantage because he's paying fair market value rent rather than the mortgage, utilities, whatever he'd end up with on a home office deduction.
Right.
Yeah, that is true. That's true. And of course, his family is going to have rental income.
That's right.
But you're correct. That's reducing his self-employment tax, and the payment that he makes to them is not subject. They don't have self-employment income because this is a rental activity, not subject to self-employment tax. So yeah, you're absolutely right. That works, and that does increase the benefit.
I see. Thank you.
So Matt is saying $850 of rent only saves $130 of the payroll tax. Well, yeah, it depends on. Well, he's meaning $850 a month, but yeah, if you're in, it's 15.3%. So right, that's correct, Matt. Okay. Some great questions. Do we have any more questions? I'm going to start to unmute people, see if we can avoid getting too much noise. But, got noise there. Sorry, C. Have to mute you back. Flora, I'm going to unmute you, or try. Yeah, oops. That seems to be working fine. Hi, Joel. I'll unmute you. Hi, John. And as I'm unmuting you, if anybody has a question, just shout it out. So this seems to be working fine so far. Kevin, and then Kurt, and Magdalena. Marlena. It's starting to get a little noisier. Anyway, if somebody wants to be unmuted, they could just put their name in the chat and I'll unmute you. Well, I guess that's, if there's no more questions, that's about all I have. Once again, I'd like to, well, you know, my name's John Huddleston. I'm a CPA with Huddleston Tax CPAs. Our focus is small businesses, so we're available for tax return preparation, for consulting. We do some business valuation work, some tax planning. We also, some of the CPAs here do QuickBooks training, and we even do some bookkeeping. So basically any kind of tax and accounting services for small business, we help on those issues, as well as business coaching.
John, can I ask a question?
Yeah.
John, this is Joseph. This may not be a tax specific question, but you mentioned the benefits of the liability protection that's accrued from the LLC corporation. Can you just spend a moment weighing in on that?
Well, the theory with both the LLC and the S Corp is that actions that are taken within those companies, liability is limited to the assets of those companies.
Okay. Did you go away? Are you back?